Here is what most people have wrong before they even start. A family office is not something you build after you make $1 billion. It is not a marble lobby and a team of 12 with business cards that say Chief Investment Officer and Director of Family Governance. That version exists. It is real, but it is not where this starts. This starts at $5 million. And if you have $5 million, you are already standing on the first rung of a ladder that, if you climb it correctly, ends somewhere most people cannot picture from where they are standing right now. Let's be precise about what $5 million actually is. It is not generational wealth yet. It is the beginning of the infrastructure problem. Below this number, a good financial advisor and a competent CPA can manage most of the complexity. At 5 million, the complexity starts to outpace the tools. You have multiple accounts. You have entities, or you should. You have a tax situation that has layers. You have insurance that may or may not match what you actually own. You have an estate plan that your attorney drafted 3 years ago and which may or may not reflect the current tax environment. You are not a billionaire. You are someone whose financial life has become a part-time job that you are not qualified to do and do not have time to do correctly. That is level 1, the multifamily office client. At roughly 5 million in investable assets, you become eligible for what is called a multifamily office, or MFO, relationship. The word multi means you are sharing the infrastructure with other families. You are not the only client. You are one of dozens, sometimes one of hundreds, depending on the platform. What you are buying is access to institutional grade services that you could not afford to build alone. Manager due diligence. Consolidated reporting across every account, every entity, every custodian, pulled into a single view. Tax coordination across your income streams. Estate planning coordination. Not estate planning itself. Coordination, meaning someone who sits between your attorney and your accountant and makes sure the left hand knows what the right hand is doing. Insurance review, basic investment policy construction, the framework of a family office without the dedicated staff. The difference between a Goldman Sachs private wealth management experience and something closer to a Bessemer Trust style platform is worth understanding. Goldman at this level is primarily an investment management relationship with planning services layered on top. The investment architecture is central. The advisor is sophisticated. The resources are real, but the model is built around managing assets. Bessemer-style platforms, and there are several firms operating in this tradition, orient around the family balance sheet first. Custody, reporting, manager access, planning depth. The investment management is one component, not the entire frame. Neither is better in the abstract. They are different orientations, and neither one, regardless of the name on the door, is a family office in the full sense. A brand name is not an office. An office is an infrastructure. You are renting a floor of someone else's office building. That is what level 1 is. What daily life feels like at level 1 is this. You are still the quarterback. You still make every call. You still sit at the table and approve every recommendation. The difference is that you now have people feeding you better information before you decide. A quarterly report you can actually read. A tax projection in October instead of a surprise in April. A document that says here is what your estate looks like if you die this afternoon, and here's whether it matches what you actually want. You receive more paperwork, you attend more calls, you answer questions you did not know you needed to have answers to. It is not passive, it is organized. The annual cost at this level ranges from roughly $50,000 to $120,000 per year. That includes AUM fees typically in the range of 0.5% to 0.75% at this asset level, plus planning retainers that may run $15,000 to $40,000 annually, depending on the complexity of your situation. You will not see the AUM fee as a line item most of the time. It comes out of the portfolio. That is the part you have to decide how you feel about. The trade-off is standardization. You are one family among many. The reporting template is not yours. The model portfolio has some customization, but it has limits. The planning calendar runs on someone else's timeline. You have less privacy than you think you do. Not because anyone is careless, because your data lives in a system that also holds other people's data, and systems have surfaces, and surfaces have exposure. You accepted this the moment you signed the onboarding documents. Most people do not think about it until later. Level 2 is $25 million. This is where the virtual family office becomes viable. The virtual family office, sometimes called the outsourced family office or the coordinated team model, is not a place. It is an arrangement. You hire or retain a set of specialists, a CIO or OCIO firm, a CPA with family office experience, an estate attorney, an insurance specialist, and a single coordination layer whose job is to make all of them work together on your behalf. The coordination layer is either a family office consulting firm, a multifamily office operating in a more customized capacity, or in some cases, a single trusted advisor who manages their relationships. The team is yours. The infrastructure is still shared with the professional's other clients, but the agenda is yours. What this office actually does is specific. It runs a cash flow and tax calendar for the year. It manages the entity stack, the LLC, the irrevocable trust, the charitable vehicle, the business interest if there is one. It tracks K1s. It coordinates the family meeting, which at this level is no longer a conversation at Thanksgiving. It is a structured, annual, or semi-annual event with an agenda and follow-up items, and sometimes a professional facilitator. It builds the philanthropic structure if you want one. It documents the family's investment policy in a form that survives personnel changes. Daily life at level 2 looks like more meetings and more process. You have a monthly call. You have a document portal. You have a shared calendar for filing deadlines and funding events. Your spouse needs to be oriented. Your siblings, if they are involved, need to agree to the structure. There are decisions that used to take an afternoon that now take 3 weeks because 4 professionals and 2 family members need to weigh in. This is not inefficiency. This is governance. But it feels like inefficiency until you have done it long enough to feel what it prevents. The annual cost at level 2 runs from $150,000 to $350,000, depending on complexity. OCIO or CIO fees, planning retainers, project fees for estate work and entity formation, and the coordination layer. Here's a trade-off that nobody explains clearly enough. The more you professionalize your financial life, the more you turn your family into an organization. There is a decision latency that did not exist before. There is a spouse who needs to be onboarded into the process and may not want to be. There is data, significant, personal, multi-generational data, flowing through systems and inboxes and portals. The privacy you assumed you had at $5 million is already partially gone at $25 million. Not because anyone took it, because you traded it incrementally for infrastructure. That trade has real value. It also has a real cost. The ladder goes up. The price of climbing it is not only money. At $100 million, the conversation about outsourcing ends. You are no longer renting space in someone else's infrastructure. You are building your own. The single-family office, the true SFO, begins here. Not because 100 million is a magic number, because at 100 million, the cost of in-house talent becomes rational relative to the complexity you are managing. Below this threshold, the math does not work. Above it, the math changes. You are no longer weighing whether you can afford a chief investment officer. You are weighing whether you can afford not to have one. Level 3, approximately $100 million. The core hires are 3. An in-house CIO or lead investor who owns the portfolio architecture, manager selection, and capital allocation decisions. A general counsel or senior attorney who handles entity administration, trust oversight, regulatory exposure, and anything that touches liability. A tax strategist or controller who runs the accounting function, manages the entity stack, and looks for what the industry calls tax alpha, the structural returns that come not from picking better investments, but from holding them inside better wrappers. These 3 people cost somewhere between $900,000 and $1.4 million per year in total compensation, depending on market, experience, and the city where your office sits. You will add a COO and a family office administrator. You will add an executive assistant who manages the calendar for all of them and for you. The annual run rate for a functional single-family office at this level sits between $2 million and $4 million per year before investment expenses. What the office actually does is different in kind, not just in scale, from what came before. The portfolio construction is internal now. Manager negotiations happen directly. You are not paying through a platform's fee structure. You are calling the fund manager and negotiating terms, co-investment rights, side pockets, fee breaks at your capital commitment level. The tax function is not reactive. It is calendared. Entity distributions, trust funding, charitable giving, realized gains, all of it coordinated in advance because a single unplanned event can cost more than a quarter of your staff's salary in unnecessary tax. Risk management has a physical dimension now. Security protocol, cybersecurity for the office systems and the family's personal data, physical security planning for principals. These are not hypotheticals. They are line items in the budget. Daily life at level 3 has a cadence, a standing investment committee meeting, weekly or bi-weekly. A reporting cycle that produces a consolidated balance sheet across every account, every entity, every trust, every alternative investment with its own reporting lag. Staff management, which is to say people management, which is to say that you are now running a firm and your firm's most important client is you. That is a strange position. It produces a strange gravity. Decisions that once took a phone call now require a memo. You sign off on hires, on vendor agreements, on investment recommendations that your CIO has already analyzed. You are not removed from the decisions. You are the governance layer above the people making them. The trade-off at level 3 is one that the industry does not say aloud in pitch meetings. Your family has become the client of an institution that your family owns and funds. The professionals in the office work for you, but they are also professionals with careers and opinions and, occasionally, agendas. The privacy you traded incrementally on the way up here is now held inside a building with an employment roster. Every person who works in your family office knows more about your financial life than most people know about their own families. You manage that risk by paying well, by using NDAs with teeth, and by hoping that talent retention is strong. You will still lose someone eventually. They will land at another family office across town. This is the industry. You will have managed around it before it becomes a problem. You hope. Level 4, approximately $250 million. The institutional single-family office. The difference between level 3 and level 4 is not headcount. It is operating risk. At $250 million, the office is no longer only managing capital. It is running operations. A real estate team because the portfolio now includes direct property holdings that require asset management, not just financial tracking. A private equity and direct deal function because at this scale, you are not only buying into funds, you are co-investing alongside them, writing checks directly into operating companies, and accepting the diligence burden and the concentration risk that comes with that. An investment committee with formal governance, voting protocols, dissent documentation, and a paper trail that would survive regulatory scrutiny. The build-out costs are real. Deal team compensation. Operations and accounting staff who can handle fund-level reporting from private vehicles with quarterly close cycles. Legal overhead for transaction work, because every direct deal generates legal fees that are not covered by your GC alone. A technology stack that consolidates reporting across public markets, private equity, real estate, and alternative vehicles into something a human being can actually read. Total annual run rate at level 4 is between $5 and $9 million. Some offices at this size run more. Daily life is deals, diligent cycles that take 6 to 12 weeks. Deal flow politics, meaning the question of which family members get access to which co-investment opportunities and whether the answer to that question is the same every time and whether everyone agrees it should be. More travel, management company visits, property tours, GP meetings, annual LP days for every fund in the portfolio. The office has a rhythm now, and the rhythm is relentless. The trade-off at level 4 is concentrated bets and internal power. When you write a direct check into an operating company, you are not diversified, you are invested. And the people in your office who source that deal have a relationship with it, a professional identity attached to it, and a performance review connected to its outcome. Internal power dynamics in a family office at this scale are real, and they are sometimes quiet, and they are occasionally not quiet at all. Level 5, $500 million and above. The Dynasty office. This is where wealth management becomes family management. The office at this level is running multi-generational trusts with independent trustees, trust protectors, and distribution committees that may include family members who have never met each other. It is administering a foundation with a grant-making strategy that reflects the family's values and also manages its reputational exposure. It is designing a family governance structure, sometimes called a family constitution, that specifies how decisions get made, who has voice, who has vote, what happens when the family disagrees, and what happens when a member of the next generation wants out. Rockefeller-style governance mechanisms exist at this level because they were invented at this level. Family councils, annual family assemblies with structured agendas, education tracks for next generation members, not investment education first, stewardship education first. Voting rules that distinguish between financial decisions and governance decisions. Dispute resolution processes that sit outside the court system. The family has a privacy and media protocol. Because at $500 million, the family is a public fact even if it has never sought to be. The office manages that exposure the way a corporation manages its communications function, deliberately. The cost at level 5 is the highest fixed overhead the latter produces. Specialized advisors layered on top of full in-house staff. Dynasty trust attorneys, philanthropic strategists, family governance consultants who fly in for the family assembly and charge accordingly. Security professionals managing both physical and digital threat surfaces. The annual run rate at this level does not have a clean ceiling. What daily life looks like is stewardship as a full-time profession, not for you alone. For your children, and depending on how the trusts are structured, for their children's children after decisions you make this year. The Family Assembly is an event on the calendar that requires preparation, facilitation, and follow-up. The stewardship metrics, the measures by which the family evaluates whether the office is doing what it was built to do, are reviewed formally. The question of who is entitled to what and who decides, and how the deciding happens, is answered in documents that outlast the people who wrote them. The trade-off at level 5 is identity. The structure that protects the wealth also shapes the people inside it. Children who grow up knowing that a family office exists on their behalf grow up knowing something about themselves that most children do not know. What they do with that knowledge is not something any governance document fully controls. The dynasty can produce stewards. It can also produce entitlement or detachment, or people who spend their 20s trying to prove they exist outside the frame of the family name. The office cannot fix this. The office is the frame, which brings you back to the only question that actually matters at the end of this ladder. At what point does wealth management become family management? And once it becomes family management, is the family better for it? The answer is not obvious. The answer depends on whether the family wanted to be an institution and whether the people inside it were asked before the documents were drafted. Some families thrive inside structure. Some families disappear into it. The dynasty is worth building if what you are building is something the people you love want to live inside. If the answer to that question is yes, climb. If the answer is uncertain, that uncertainty is worth more of your attention than the next rung ever will be.